XAnalysts. Empowering analysts, transforming markets.
Hello, everyone. Welcome to XAnalysts Exploring the Energy Markets podcast series. The purpose of the podcast is to dig deeper into topics related to energy markets with experts across the globe. The bottom line is to uncover and understand the competencies, the skills, the experience, the knowledge that drives high quality analysis. The ambition is to inspire analysts. The ambition is to 10x the game of analysis. Today, I have a special guest, Alex Hillman. Alex is a lead analyst at ACCR. ACCR stands for Australasian Centre for Corporate Responsibility. Alex has degrees in chemical engineering and finance. That's a very good combination. He has worked more than a decade in oil and gas in Australia, spending 5 years at Woodside Energy as a climate advisor. His areas of expertise is energy transition, understanding deeper ends of LNG business and technology, asset and company forecasting, climate policy, and financial modeling. Today, we will be digging deeper in trying to understand the analysis behind and the insights of what drives the returns in the fossil industry. There is always a talk around the fossil industry's returns versus the renewable industry's low returns. Today, we will try to dig deeper in understanding why the fossil returns may not be as great as it used to be. With that, welcome, Alex. Welcome to the podcast. The purpose, as we talked about for this podcast, is to really dig deeper and granular into the energy markets. And tell me a little bit about yourself, your journey in the energy markets. And I'm very curious to understand that you worked in the oil and gas sector, and then you shifted towards the climate side. So how's the evolution of your journey?
Yeah, interesting. Thanks for having me on the podcast. Great to be here. So I guess through university, I did engineering and finance degrees. So I've had both of those kind of, someone described it as money and machines, formal education. My first job was at an oil refinery just south of Perth in Kwinana with BP. So I started in big oil or downstream big oil. And then I started paying a bit more attention to climate issues. So I left big oil for a couple of years, did a whole bunch of different things, but then had an opportunity to come back into big oil with Woodside. And I was project managing, some rewrite of some technical documentation. And then I spent 5 or 6 years as Woodside's climate change advisor. So when I started that role, I was the only climate person at Woodside. I think I actually started in the climate change role the day that Australia's carbon price was repealed. So it was a really interesting time to be doing climate change with big oil. Big emitter. And so I left, and now I work for an organisation called the Australasian Centre for Corporate Responsibility, and we're a shareholder advocacy and research organisation with a pretty strong climate focus. So we're a philanthropically funded NGO, and what I do there is I'm the lead oil and gas analyst. So started at unpacking the climate plans of these large oil and gas companies, but increasingly the business plans as well. So we look at the strategy of these companies, we look at the emissions impacts of that. We look at whether it's actually adding value for shareholders. I'm sure we'll get onto some of what we found through that research.
Well, fantastic. I mean, having an engineering degree and then finance, I always find that fascinating combination because there is a lot of technical details when you do financial modeling that get missed. So I think I'm sure that has stood a lot more valuable to you. Over this period of journey, right, and we will talk more about how the oil and gas sector in Australia has performed. Anything that comes to your mind, what has changed dramatically, the way you look at the industry, the way you look at the market, any, light bulb moments, aha moments? I'm sure many, but any few you can bring out.
Yeah, I think, when I was with BP on an oil refinery in Australia, so, a long way from the head office, the kind of impression I had there was refining was a really low tight, low margin, tight operating sort of sector, and kind of like, BP, the refinery would describe itself as like a backstop for BP's oil trading division. So, if they bought a cargo, didn't really have a home for it, it's like they send it to Kwinana will just have to deal with it. So it was like the refining bit just enabled the trading. But, upstream and the trading was always seen as this really high value part of the business. And then when I got to Woodside, I think kind of the general vibe of the business environment that I had there was, getting a major project to FID was really challenging. But it's a really high returns business. The assumption and the vibe was that, it does generate really strong returns and there's huge amount of value to be created. And then I think the big kind of light bulb moment for me is, when I stepped out of being within the sector to analyzing it from externally, like it's actually just a fairly low returning business. So, oil and gas, or the energy sector hasn't done very well for, quite a long period of time. Obviously highly volatile, things like Ukraine, and COVID, swings and roundabouts. But over the long term, 10, 15 years, it's actually a really poor performing sector. And so that's completely different to how I viewed the sector when I worked within it. Yeah, and I'm actually quite surprised that so few people, within the sector kind of have that as part of their day-to-day understanding of how the sector performs.
So let's dive deeper. I think that's a fascinating view, which I think let's dig deeper. The typical understanding, if you read around the media, if you ask chat GPTs and the kind of the AI answers,
Yeah.
the impression is that oil and gas, high returns business, whereas the renewables have become very low return business. In the renewables, there is so much of overcapacity that developers can't meet margins, but and that's why a lot of companies have made U-turns into their programs, U-turns into their decisions. I used to work many years at Shell, BP. We have seen quite the dramatic shifts in their policies. But if you believe that the returns are low, tell me a little bit more. What grounds, what's the basis on, and how do you arrive to that view that oil and gas has not performed well?
Well, it's just total shareholder return is the metric we look, we anchor a lot of our analysis on. So, the returns to shareholders, the owners of these oil and gas companies, over that period of time have been mediocre. So over 10 and 15 years, I think it's about 6% return for the energy sector. Most of the energy sector is oil and gas. I think 99% is either gas producers, gas explorers, or service companies. And that's about half of the broader index. So, through the cycle, when you smooth out those highs and lows, the sector delivers roughly half the return of the average share. So, it's not our analysis. This is just data that anyone with a Bloomberg terminal login could just look up. Just look up the TSR of the World Energy Index over, extended periods of time, and you can see it. So, yeah, as I said, it's not our analysis. It's just historical fact as published by Bloomberg. So, the diagnosis of why that is gets a bit more interesting though. And you've raised some interesting issues about, oil and gas versus renewables. So I think, a lot of what we see from companies when we highlight poor performance is they respond with relative performance, relative to peers. And so, if you are in a systemically underperforming sector doing as well or maybe a bit better than your peer, may still not mean you're doing very well. So, outperforming an underperforming sector, it doesn't say whether or not you're delivering strong shareholder returns. It just says you're possibly not as bad as the person next to you. So I think a lot of it is about framing. A lot of the analysis that gets done on the oil and gas industry is done by oil and gas people who spend a lot of time thinking about oil and gas. And I think, part of it is if you just step back a little bit and go, okay, well, how does oil and gas fit within the whole equity sector? You get a very different perspective than if you're asking a question, how does Shell or BP compared to a Woodside or an Equinor?
Yeah. So any, like say for the average audience, Alex, what would you say drives this as you're saying, the mediocre performance? Is it the volatility on the revenue side? Is it the cost side? It is the OpEx? What really is the measure or the parameter that really has pulled down the returns?
Yeah, so we've just published a report, looking at, we did the calculations for literally every company. What we published was for 10 companies, the super majors and a few others that we spent a bit of time thinking about. And what really drives the behavior, so the kind of core question we asked with this analysis was, if these companies stop building new projects and stop exploration, more conventional exploration, conventional new projects, what would their value be? And what we found is that across these 10 companies, they'd be $78 billion more valuable. The main driver of that.
Let me stop there. I think you said something important. If these companies stop doing what they're doing, they will become more valuable.
Correct.
Okay,
yeah,
it's
quite counterintuitive. Yeah, it's quite counterintuitive. So, and as we unpacked this, it's like, well, what's driving this behavior? It does sound counterintuitive. These companies are getting smaller as a share of the share market. They're not delivering long-term return or strong long-term returns, but many of them are still hundreds of billions of dollars. They're still large companies. So it's like, how can a multiple $100 billion company, not make money by doing more of it? Like I agree, it is quite counterintuitive. So we spent a fair bit of time unpacking that.
Mm-hmm.
The main thing we found is exploration costs. So through the 60s, 70s, 80s, 90s, like through the last century, exploration generated a huge amount of value. So a dollar spent on exploration in the 60s, from memory, we created $6 or $7 worth of value. In the 1990s, a dollar spent on exploration turned into about $1, so basically break even. And since 1990s, each dollar spent on exploration has turned into 21 cents. So you've eroded, on a risk-adjusted basis, spending money on conventional exploration has eroded 79% of the value. And so of that $78 billion, most of it relates to exploration expenses, which find, just a small fraction of the value compared to their cost. So it's a massively value erosive activity. So that's the biggest thing, is exploration for multiple decades has not created value on average across the sector. Probably the next thing that, we saw in our analysis is, and this started, I guess, a few years back. We did a study of Australia's LNG sector, and we just looked at the raw data. We rely heavily on Rystad, who, I'm sure you're familiar with their data. We just looked at the raw data of the cash flows of Australia's LNG projects. And what we found, we reconciled that to ASX statements, media announcements, what these companies were saying through the construction of these projects. And we found that every single one of Australia's last 8 LNG projects was late and over budget. So on average, they were 35%
over budget. Okay.
Correct. Yeah. So at least the next year, sometimes 2 years after the original FID guidance for startup, and on average 35% over budget. So that eroded compared to the cost of capital. That wave of investment eroded $20 billion US. So
is
is
it because, sorry to interrupt, but is it because that the project execution, or it's the technical strength, or has it any regulatory policy, permitting, approval? Because I've been speaking to many people that those things have become harder. There was one guest on my podcast which mentioned that if Australia was to use the kind of permitting and approvals it uses today, all of these projects would have never come back. So is there an angle of that there or no?
Yeah, it's a good question. Like part of that research looked at how companies themselves described what went wrong.
Mm-hmm.
And one thing that really stood out to me, like beyond the high level conclusion that cost and schedule slipped significantly, is that the justification the companies provided was completely inconsistent.
Mm-hmm.
So, I think what that speaks to is it's a complicated sector. Like a large oil and gas project, a $5, $10, $15 billion oil and gas project is extremely difficult. It takes, probably decades from, typically over a decade from discovery to, first revenue. And so you don't get people who have done this, lots and lots of times. So, if you're an engineer, you spent your whole career building LNG facilities, you saw them from discovery through to first production, you might do 3 of those in your career. And so because they're big bespoke projects that take a decade or more sometimes, you don't have that opportunity to learn. You don't get to do these things thousands of times and get better every time. Like it's not like you're building a house where you build a roof and then next week later you build another roof. You know, like many other
Okay,
professions,
so the
you
learning
learn
cycle
by
is
doing.
long. The learning cycle is
Correct.
long. Yeah.
Correct. Yeah, and you see that in the cost profile. You see renewables just get cheaper and cheaper and cheaper and cheaper because you're making a solar panel is or installing a solar panel is something that someone with no skills can do hundreds of in a day. So like it's
That's
a
a very
completely
interesting
different
point,
market.
Alex, that in the renewables, maybe one reason you are mentioning the costs have come down
Yeah.
is
Yep.
that the ability to learn and do it better, you get the opportunity of execution and seeing the results faster compared to these mega oil and gas projects. No,
Yeah,
that's
yeah.
a very interesting point.
Yep, definitely.
Mm.
So, these companies themselves, some describe foreign exchange problems, some describe change of scope, some, Pluto, Woodside's project. They got to 95% complete and then had to issue an ASX announcement saying that actually the installation wasn't installed properly. They're going to have to strip off the installation and reinstall it. So, really diverse reasons why these projects, didn't get executed to plan. And I think fundamentally it's just complicated. It's a difficult sector because it's very complicated, intricate engineering. Obviously, huge process safety risks, extended timelines, a whole bunch of things make this just a difficult sector. So, we're not saying that these companies are inept or that, but it's just a hard place to make money. Even if you're very good at it, like
Good.
it doesn't deliver strong returns.
So let me, Alex, right, these are very counterintuitive, thinkings. The purpose of this podcast is to really also understand the best practices of doing analysis, right? And I'm sure
Mm,
as you have done this work over the period of years, if there is a young person who is looking into the same data, looking at the numbers, how would you describe the process, the mindset, the philosophy, or what a best practice analysis would look like?
yeah. Yeah, I think, I enjoy thinking about how to craft information and well, how to pull information together in interesting ways. So, you know, we combine a bunch of data sets, Bloomberg data, Rystad data, IEA data. And I think one thing is just like constant curiosity. It's like I've got a data set, it's a bit different to another data set, but what could I learn if I try to smush them together? How can that
Mhm.
data interact with each other? So I think that constant curiosity, and almost like looking, maybe an analogy could be like a chef who's got a bunch of ingredients and it's like, okay, what could I make with these? Because you rarely have perfect data. You've got to be a bit kind of you use a bit of initiative to pull that together. So that's something I enjoy. Hopefully it's serving well. Hopefully the analysis that we put out at ACCR is interesting. Maybe another thing, and I think we touched on this earlier, is thinking about things at different scales. So what we generally do is we do asset level analysis and then we aggregate it to companies and to sectors. But as I said earlier, if you're going to look at the performance of a company, comparing it to another company is interesting, it's useful. Comparing it to the whole sector is interesting, is useful. Comparing it to the whole market is interesting, is useful. Comparing oil and gas to renewables is interesting and useful. So, you get different insights when you look at different scales. And I
That's a
think,
very important. I think you're saying that the law of averages may hide and cancel each other. So if you start looking at a project by project versus when
mm,
you aggregate, a lot of things may cancel
yeah,
each other and
yeah.
may hide. So more granular is what you think is the better way to look at project by project.
Well, we do bottom-up analysis, to draw sector-wide and company-wide conclusions. I think because that's more rigorous. When you
Mhm.
start with granular data, there's few, at least having more detail there, lets you unpack things and repack things in different ways. But I think that the thing is sometimes you want project level data, sometimes you want company data, sometimes you want national data. So it's that mix of different perspectives at different times to draw out different insights.
Mm. One question I wanted to ask, Alex, because this is an important analysis, right? Which I believe informs government, people, public at large. when you have multiple data sets, there are different assumptions by everyone made, right? So when you
Yeah.
aggregate, you merge and combine, there is a bit of a danger I have seen in my experience that the one made an assumption of $80 per barrel, the other made maybe a 70 or a
Yeah.
90. And then, so
Yes.
how would you say someone who is, deep into it takes that challenge of consistency of assumptions
Uh,
behind the numbers?
yeah. Going back to that chef analogy with a bunch of ingredients, sometimes you just got to deal with what you've got.
Hmm.
Ideally, you could recut the data. If you've got NPVs at a certain price, hopefully, depending on what your data source is, it'd be great to recalculate those NPVs at different prices. So if you can harmonize the data, that's obviously a good thing to do. And sometimes that brings a set of assumptions or a set of, approximations. Obviously being super transparent about all of that, because that will be a caveat to any conclusions that you're drawing. At other times, just transparency is just understand that the data is inconsistent, and just be very clear. It's like, even though we've used inconsistent data, it seems to draw this conclusion. But, obviously we won't pretend it's more precise, it's more rigorous than it is. So, I think that intellectual integrity of
Hmm.
understanding the limitations and being super clear about the limitations of what you've done, I think is really important. But yeah, obviously, if you can harmonize data and you can make it all consistent, then that's the best place to be.
Now, I think if I peel the layers a little bit more, one is an input data points, right, which you aggregate, you collect what is best available. How has the modeling exercise, the tools, the financial models, your expertise in financial modeling, I believe over the years, how much tools and models have changed and evolved, or practices, or that has stayed the same?
I've got to admit, I'm a hopeless Excel tragic. I think we're probably reaching the limits of what Excel can do. One of the data sets we used in that report, that to look at that, expiration and the value, that 79% value erosion from expiration, it was 150 megabyte Excel file. So the calculations weren't super complicated, but it was, every dollar of cash flow out of Rystad, for conventional oil and gas, over multiple decades, probably 150 years worth of data. So you know, just opening that spreadsheet would make my computer start to struggle. But it's still what we love using Rystad data though. So the
Mhm.
UCube format, like basically a gargantuan pivot table where you can pull data out. That's super useful, and a really great way to access data.
Mhm.
But I heard of another group just yesterday. They use Spotfire. We got several people in our organization that love using Python and R. So we're slowly moving towards and I'll probably get dragged kicking and screaming towards using some programming language to manage bigger, more complicated data sets.
Data sets. Now, I tend to agree that, yeah, Excel still, because I remember that the moment Excel is at least transparent, otherwise a lot of
Mhm.
softwares can become a bit more black boxy. Okay,
Yeah.
so Alex, I want to explore further that it takes years and expertise to build this ability to look into the data. Now, a lot of people who come out of the universities and, and graduate, the kind of opportunities they get to analyze these kind of projects. What advice, what guidance would you give them that which you think if you had done this early in your career, your way of
Mm.
analyzing the markets and the numbers would be different? Anything specific you would say?
Maybe two things come to mind. Like, so one is, just understand the subject matter. So building a commercial model of something and, dragging a formula to the right, to keep with the Excel analogy. It's easy to put numbers in Excel and to get numbers out, but in order to understand what they mean, how reliable the assumptions are, you want to understand the sector. So, I spent a bit over a decade in the oil and gas sector. Obviously learned some things during that time, but I'm constantly looking to learn more. I speak to old colleagues. I keep reading as voraciously as I can. So you want to be as much as you can an expert in the subject matter of what you're analyzing. I got a colleague who spent a lot of time as a portfolio manager dealing with telecom stocks. And so watching him pick up oil and gas has been amazing. So, you obviously can keep on learning. So probably one thing, and probably the other thing is to hindcast, is to look backwards as well. So, I think, as well as the kind of, you can call it an analytical diagnosis of why we think the oil and gas sector hasn't done very well. I think part of the psychological reasons is that it continually looks forward. So obviously, if you're considering an investment decision, it's only the future that matters. If you've got sunk costs, that shouldn't change your decision. But I think when you're thinking about a strategy, when you're trying to understand something more complicated than a single FID decision or a single investment decision, you want to look back to how history's gone. So, in the example I gave before about that, $78 billion upside of ceasing conventional development, most of that value is in exploration. So you can rationally make investment decisions in new conventional projects which make value, while the strategy of building conventional projects doesn't make value. And I think, firstly, stepping back and go, how's the sector behaved over multiple decades is useful perspective. But also, if you're going to assess the strategy, it's like a series of positive NPV FIDs isn't sufficient. Like you need to look at the full value chain. So I think, like spending more time looking backwards to inform your opinions of the future would be one thing I'd advise.
Now, there's 5 minutes. So the carbon markets, right? The carbon pricing, as you mentioned, is going to be and is becoming a more important factor, which needs to be factored into the entire cash flow modeling, right?
Yeah.
How easy or difficult is pricing carbon in assessing these projects? And what's your experience so far on that point?
Yeah, good question. So yeah, I spent 6 years at Woodside doing their climate change role. Part of my job was to recommend carbon prices. So it wasn't my decision, but I fed into the process what carbon prices we should assume. I led the emissions reporting. I did all the safeguard, the compliance, modeling to work out, optimum strategies on how to manage that. So I spent a lot of time thinking about that, in my Woodside days. But now at ACCR, we actually do very simplistic carbon modeling. So, one of the things I think the sector likes to focus on, and it's understandable. You're an oil and gas company. You have some emissions because you burn some fossil fuels on your assets. You may or may not pay a carbon price on those. It's what you know. It's what you can control. It's what you spend more attention to. But when you look at the value chain of fossil fuels, LNG, where I spent most of my time, about 7 to 8% of the gas that gets out of the ground is used processing the gas into LNG and putting it on a ship. So when you look at what carbon means for the sector and what a climate constraint means for a sector and a whole business model, if you're just focusing on your scope 1 emissions, those emissions happening at your facility, you're missing 93% of the problem. So the way,
let me hear it correct. 93% of the carbon impact gets missed if you just focus on your own processes. Is that?
Yeah, that's a reasonable number for LNG. Obviously, it's different in different sectors. I think for an iron ore miner, you might have 5% of your emissions come from your own operations and 95% come from downstream. So you've got 19, 20 times as many emissions that are in your value chain than are in your operations. So if you're thinking about carbon pricing as a regulatory obligation, which may have a carbon price, then you got to focus on the LNG example. You focus on that 7%. If you're thinking about a climate constraint as something that society is going to fix and will affect your value chain, obviously you need to look at that big picture. You need to think about 100% emissions. You need to think about shipping emissions and regasification emissions and end-use emissions. And so, part of what ACCR says when we talk about, climate reports from companies is often go, well, what's the value chain? It may or may not be constructive that they've set a scope 1 or scope 1 and 2 target. But, they need to deal with emissions. Their business needs to be resilient and to have thought through the emissions through the whole value chain. So the way we actually do oil and gas emissions calculations is actually really rudimentary. We just get saleable product and we assume it's burnt and we multiply the emission factor, so a combustion emission factor by the production, and then that's the number of megatons or gigatons of emissions. So it is really simple. Probably underestimates emissions by 10 or 20%. There'll be some methane along the value chain in a gas value chain, for example, which we don't model. There'll be some scope 1 emissions that we don't model. But that analysis we did about ceasing conventional oil and gas, that would avoid 6 billion tons of emissions, like a globally significant amount of emissions, while making these companies $78 billion more valuable. If that 6 billion tons was 7 billion tons, it wouldn't really be relevant. So I think a lot of emissions, a lot of people spend a lot of time thinking in a lot of detail about emissions, but if you look at the value chain and you screen your process and your analysis through materiality, for what we do at least, it becomes a lot simpler.
Any further thoughts?
When you take that value chain perspective, one thing that I think I found really, really surprising is how, we've said a bit about how low value the sector is. When you look at the value created per emission, it's single-digit dollars per ton. So, you look at a project like Browse, for example, its NPV divided by its scope 3 emissions is $3. So if you think about what that means and how, I guess fragile these business cases are, even a much more attractive project, we looked at BP's portfolio, its highest value project on that NPV per ton of emissions was $20. So you see carbon prices around the world, ranging from, say $5 to $80, maybe even higher, some European countries. And when you compare that to the value that these companies are creating for themselves, I think we've seen our society is willing to bear carbon costs which exceed the value created for these companies. Does that make sense? Like it's not a metric I see other people use, but I think it's a relevant way to think about, the cost and benefits of emissions within an energy value chain.
No, I think it's a relevant point because I've spoken with a couple of people in the biofuel sector and life cycle analysis. The entire impact is becoming quite critical. So if we are valuing the green sector with those kind of lenses, I believe it for a fair comparison, it needs to be there. My kind of question is, what kind of a challenge, let's call it criticism, because we live in the age of, sometimes when you're against a certain established norm, you may get branded very quickly. I've heard the terms, too much activism and all those kind of things, right? So how is that the number crunching on the financial metrics not accepted by, or is it accepted by the players themselves? Where do you find you get the most challenge on?
Yeah, it is a really good question. It's something we think about at ACCR a fair bit. We're quite open. We have a like a transparent objective to help mitigate climate change. But the analysis is all bottom up. We like to think our assumptions are all rigorous and transparent. We're not kind of reverse engineering those sort of results. But when we test our results and our approach with people, I'm always surprised how little pushback we get. So, that report with that $78 billion value in it, we did a roadshow pre-publication. We spoke to a few Australian investors, we spoke to a lot of European investors, we spoke to sell-side analysts. And one thing that was really surprising to me is, I expected, especially the sell-side analyst conversations, to be quite contested. These people get to think deeply about it. They're probably quite attached to the sector. But we spoke to, say, 4 or 5. Those who had done similar work agreed with our conclusions. So, the first meeting we had, we expected, like I said, expected it to be quite contested. And he just flicks through the deck and he goes, oh, yeah, I did something similar for another company. This is what I found.
So somebody in like Woodside or these kind of companies who are doing the project calculations, will the numbers match, or will there be a difference in how they look at how you look at, and why?
Yeah, I think one of the ways we try to address that possible issue is we look at total shareholder return. So it's a measure of history. It's very precise. there's no uncertainty what the total shareholder return is, and go, well, like Woodside, for example, over 10, 15 years has delivered less value than inflation. So, they can disagree with our diagnosis of why their business model isn't delivering value, but it's a historical fact that their business model has not delivered significant value. So the sort of responses we sometimes get though from companies, we're fairly openly criticizing their strategic direction. As they say, the future's going to be better. We did a piece of work on Equinor, for example, that concluded that its international expansion has cost $100 billion, but lost three. Like the NPV of that $100 billion capex spend was minus $3 billion.
Wow.
And then we did another piece where we compared that $100 billion cash flow to an investment in Norway's sovereign wealth fund. And it would have been $50 billion. So, Equinor's strategic decision to expand outside of Norway has made its investors $50 billion poorer. The investor mainly the Norwegian state, otherwise would have invested that money in the sovereign wealth fund. That would have been $50 billion more. So one of the things we did when we kind of started unpacking that is like, well, surely they know this. Their financial statements show that their Norwegian and their international division have wildly different returns. Like it's audited, their own audit data supports this. So we look back through their investor briefing days, and since 2013, basically every year, at least every couple of years, you'd see some comment that they're bringing out going, "We're going to fix this. It's going to get better." So I think culturally is the bigger problem than the analysis side. So from a dispassionate analysis perspective, we actually don't get a lot of pushback. But I think what we say is just culturally a bit awkward for these companies. Like they exist as a group of people who are really excited about building projects. And, I've been part of these companies. I know how exciting that is. You get to play with billion-dollar toys. There's not many parts of our society where you get to play with billion-dollar toys and build them from scratch. It's really cool. But I think it's just an awkward conversation for them to go, well, actually, I've been eroding value. I've been making our shareholders poorer. It's a kind of a psychologically challenging thing. So I think more and more, where HCCR's head at is it's not about the analysis. It's actually about the culture. It's about the psychology of what it means to be an executive or a staff member for these companies. And to some extent, even an investor. Like we speak to, obviously, investors are a sophisticated audience. Many know a whole heap more than me. But we see this excitement of the sector. Isn't it exciting that what's the next project? What's the frontier basin? Without that, look back and go, did the last frontier basin work out? When you look at the whole industry, has the exploration been generated or eroded value? So we think it's just kind of like people getting caught up in the excitement of the industry as opposed to the dispassionate analysis of the facts.
No, I think you bring a good point, like that, shareholder return, historical data, facts, your numbers, not our numbers, published numbers, is good to do a look back analysis. Now, two more aspects to drill deeper, because this is not an easy subject to talk and discuss about, and I'm sure this, in my view, is going to become ever more important as we go into the future. One is when we go toward the alternative, which is the renewable, right? We have seen highest volatile electricity prices in Australia. We have seen the challenges of price instability that comes with higher percentage of renewables. That's what I'm reading. I'm not saying that I've done my own analysis. I was in Spain, in Madrid, when the grid failed, and the answer I get was that there just was so much of solar and wind, and if we remove the providers of stable sources of power, electricity, and suddenly the solar and wind, which is weather related, goes down, you can't suddenly increase. So is there a way to factor in this price instability that comes with the different sector, whereas the oil and gas provides a bit of a assurance of supply, and is there a premium to be put in on it? Is there a thinking like that?
So it sounds like that's more of a energy security as opposed to financial analysis. Is that kind of where your head's at?
No,
what do we need?
Energy security is one, but the stability of the prices, because I know that financial markets projects are always done better when prices are stable, you can do your analysis and all those kind of things, right? So the oil and gas provides stability in the prices. There is an assurance that you can turn on the machine, whereas the solar and the wind and the renewables have intermittency and those kind of other challenges. That leads to higher volatility of the prices. And that volatility of the prices has its financial consequences of the system. So
Yeah.
have we factored some premium on the oil and gas, which the stability they provide, and they don't suffer the intermittency issue?
I think, I don't spend personally, I don't spend a lot of time looking at electricity systems. So I look at, electricity sources for different fuels and so on a little bit. I do look at gas markets a bit more. Yeah, and I think, my perspective is almost the opposite of what you said. When you take a different time frame to some of the stuff you're talking about, you look at the last 5 or 6 years. Russia invaded Ukraine, gas prices spiked. It took them $30-40 gas, and so saying that fossil fuels provide price stability, I don't think is backed up by on that sort of time frame. I don't think that's backed by the data. And what you've seen there is Europe has set much more ambitious clean energy targets. It's got an explicit strategy to wean itself off gas. And you've seen countries which were seen as massive emerging LNG customer markets, like Pakistan, for example. They've shifted dramatically towards solar. So, without government support, as far as I can tell, without even a lot of government awareness, like individual decision makers, households and small businesses just started importing massive amounts of PV. So I think what we're seeing is at an organized state level of the European Union, and then an individual customer level in Pakistan, is price volatility is driving a shift towards renewables. So not against renewables. So
No, it's an
it does
interesting thing.
on the scale that you're looking at, but yeah, I think at the broad macro level, I think the opposite is true. Is price volatility comes from fossils, and the answer is often to reduce fossil use and increase renewable use.
Well, I would say that this is an interesting topic to debate. For example, when in the oil side of the market, when you import barrels from African countries, Libya, Nigeria, a lot of instability. When you import the barrels from the US, you have assurance, security. So there is always premium to be paid. I think in this context is when I see that a very high penetration of solar and wind is the main reason Australia has the highest volatility in electricity prices, and that has certain consequences in terms of financial. I think probably something to think about and factor. Now, maybe two more points to explore, Alex, and I think this is again a very tricky and difficult topic, is that given the awareness, the education your teams or your analysis is bringing, I believe I remember when the shale revolution was happening, the conventional fossil fuels costs were very high, break-even costs. Shale came and busted, and then the industry became extremely efficient. Now I'm also witnessing the emergence of huge application of AI in safety, in recovery, per well. Do you see that this awareness, this understanding of challenged financial returns, a little bit, let's say, looked at from a deeper angle, will prompt these companies, these projects to become even more efficient? Are you seeing a response to this situation?
It's not something I've seen. Like I see lots of chatter about AI driving energy demands, and some chatter about AI driving efficiencies through the sector. One of the things I said earlier is if you work in the oil and gas sector and you deliver major projects that could take at least years, possibly more than a decade. And so I think the learning cycle for oil and gas is just incredibly it's a difficult sector to embed learnings. AI is an opportunity to increase efficiency in every sector. So if there are opportunities to increase efficiency in the fossil fuel sector, I'm not sure that's a competitive advantage. So it might be an advantage relative to fossil fuels previously, but every other sector has got that opportunity as well. So if you're thinking about interfuel competition, Again, what's your perspective? What are you comparing it to? So if everything gets more efficient, a reduction in cost doesn't necessarily drive a competitive advantage. It may just be that you get to keep up with your peers. So I don't know how that balance works out. It's not something we filled into, but I think assuming that because fossil fuels will get incremental, oil and gas production will get incrementally more efficient, it's going to be more competitive. I'm not sure that's a given. So I think that I would have further questions to ask before drawing conclusions from
No, I
that.
think the shale shock certainly made the conventional offshore players more efficient. And I was in Houston at that time. I see how the break-evens were falling. So
Yeah.
now, maybe to close this discussion, looking into the future, Alex, given the numbers you see, and if we make a premise that the returns on the traditional conventional oil and gas has not been as high as claimed, so
Yeah.
certainly this will attract less investments. On the other hand, the policy side support for the renewables side is also unwinding, is happening across the board, and there is a lot more challenge coming on. Uh, how do you see the future that we might end up investing less in fossil because of this knowledge, and we may not be able to scale up the renewables? Will it end up causing more energy security risks given this situation? How do you see the future given the numbers you see? Like don't invest in oil and gas because not a good business. The renewables
Yeah.
also is a low return business. So where do you
Yeah.
go? You leave the energy whole.
Yeah. It's a really interesting question, and part of the answer depends on what your role is in the energy market, or in the economy more broadly. So if you're an investor and just hypothetically you assume you're not going to make strong returns from oil and gas, and you're not going to make strong returns in renewables, then it doesn't mean you need to invest in either. So I think one of the it's almost a false dichotomy that comes up a fair bit is like these oil and gas companies, if they can't make money from renewables, they need to invest in oil and gas. But actually, if you can't make money in either, like you have a fiduciary duty to your investors to actually just reallocate the capital elsewhere. So from an investor side of things, allocating capital, you don't have to allocate capital to fossils or renewables. You can allocate capital to any other sector. So I think that false dichotomy between those two things is a little bit overstated. Again, in terms of energy security, like I said before, what I see from an energy systems perspective, fossil fuels are flows. So you extract fossil fuel, you send it to a consumer through a complicated chain, it gets burnt, you start again. Oh, you have a continuous flow. So if you have volatility or some interruption to that, then your energy supply stops. Obviously, that's very different with a renewables system. So you get a shipment of solar panels, you install those. If you can't get another shipment of solar panels, the solar panels still work. So I think in terms of energy stability, it's a very different frame of reference. And it takes a much more significant disruption to Ember call it a electric tech system. So it's a stock. You install renewable energy. You build your EVs, and then it just harvests energy, renewably and continuously. So I think from an energy security perspective, if that's your objective as a policymaker, like a government, for example, you're investing in something like a renewable system where you're not dependent on fossil fuel imports. Probably is has definite benefits. I think the main challenge that we're increasingly realizing is that just culturally, these oil and gas companies, they exist to build oil and gas projects. It's not in the best interest of many other, nearly every other stakeholder. It's not in their best interests. So I think that the big challenge we've got to one of the big challenges we've got to transition our energy system is this cultural inertia with these companies which have historically been large economic players, but are diminishing players in our economy. So that's kind of one of the thorny challenges of the energy transition, I think, is just that cultural inertia of incumbent fossil fuel companies.
No, and I think that very much fits into the kind of the passion and the mission which I have started my company XAnalyst, is to really lift the analysis game and high quality, objective, data driven analysis, as you mentioned about look back analysis, not living in an inflated bubble kind of things, will drive a better energy debate, and that's how we will make a much more informed energy choices going forward. And probably we need a bit of a mix of it, but in the right way. Now, what three things or two things or one thing 2026 ahead, Alex, from your perspective, you will be watching and something people should pay high attention?
So I've got spent a fair bit of time in the LNG sector. So I'll be closely watching Chinese LNG demand through 2026. So we saw a fall, I think, in 2024. Not many people were talking about Chinese LNG imports decreasing in 2025, but that's what we've seen. And not many people are saying 2026 is going to see a fall. So most Kepler and so on talking about a recovery in the Chinese LNG import market. I see a lot of structural drivers to suggest that may not play out. So I'll be paying attention to that. Capital allocation to upstream oil and gas. Our central thesis is that it's been a value erosive strategy and has been for some time. And that it's mainly cultural barriers that perpetuate that investment. So I'll be really interested to see what sort of changes we see out of the large oil and gas companies in terms of exploration and FIDs. And then, maybe Chinese renewables as well. So, it's probably the biggest moving chunk of the energy system is what happens to Chinese renewables now. We saw massive growth in 1H 2025 due to regulatory changes, and then a tapering off in 2H. So, whether or not that picks up again, we continue to see compound growth of solar and wind installations in China, as I'll also be paying attention to.
Well,
what do you see? What are your three key indicators you'll be tracking in 2026?
So no, thank you for asking. I think that may be another good way to close the fantastic conversation. For me, the number one thing, Alex, to really watch is that we live in a world of divergence, right? And the capital gets wasted when there is less, that there is chaos, there's no divergence, there is no convergence of thinking. And that capital wastage, I mean, in the past, oil and gas was the horse you put your money on and you win, right? Now, your analysis proving not the case. So where do you put your money on the next horse, right? Next kind of the game. And we have seen how hydrogen, how biofuels, how other sectors are not performing. So in this lack of, let's say, clarity, capital will get wasted, in my view. And that's what I want to watch. And inefficiencies will be there. And that might lead to more shortages of kind of everything. We might not have enough oil and gas. We might not have enough with the AI data centers, energy demand increasing. Are we going to walk into some sort of an energy pocket or a turbulence? That's one thing I want to watch. The second thing I do want to watch is the alignment of the geopolitics with Russia, with China, with India, with South Africa, with Brazil, and with the Middle East. If you add up these countries' total crude production, and if you add up these countries' downstream refining footprint, is kind of matching. So 2026 and beyond is no longer going to be the game of export crude oil and make money. These players have become big exporters of the products market. So I would see, and I'm already seeing, emergence of a POPEC, if not OPEC, of crude oil, kind of a cartel, a kind of a group which will control the product prices. So as energy transition demand goes down, they will now decide how much diesel to cut, how much gasoline to cut. It's already emerging, but that's something very interesting I want to watch going forward. The third and the last thing for me is that we live in the world what I call global spares and local scares. In the world, we have, I believe, enough of everything, but there is so much of, I would say, spare capacity, and then there is scare capacity, right? Scarce. Australia, especially, is now becoming one of the biggest oil product short on earth, with imports of 1.3, 1.4 million barrels per day of the refined products. It used to import only half. As we have closed down the refineries, Australia's exposure of the mining sector, which needs still a lot more the oil and gas energy, is exposed a lot more to the volatile markets outside. So I think it's a tricky balance on how fast we go on the renewable journey while we still safeguard the national sovereign interests. So I think that balance, how the political system, how the analysis system is going to balance. But for now, Australia's exposure to the oil markets, to the volatile world, has doubled over the past few years.
Fascinating. I'll pay attention to those as well then.
Sorry?
I'll have to pay attention to those trends and through 2026 as well.
Correct. So, Alex, fascinating conversation. Thank you so much. I learned, as every podcast, I learned something new. I learned something different. I'm sure a lot of the analysts who are watching, a lot of the people who are watching, paying attention. I think cost analysis, cost calculations, value analysis, I think is going to become a very critical skill sort of going forward as we go towards more challenged environments. So I think that's a skill, that's an area to put a lot of focus on, and you have thrown quite a good light on this. So really, thank you for your insights. With that,
I appreciate the opportunity.
thank you.
Analysts transforming markets.